It's the weekend, and while the market takes a breather, Opendoor's story continues to quietly evolve. The stock finished the week trading around $7.50 a share, down from its recent highs, and while it's tempting to focus on the red candles, this is one of those moments where it helps to take a step back and look at what's really happening beneath the surface. Because while some investors are losing patience, others, including people deeply familiar with the company, are signaling the opposite. They're adding, they're engaging, and they're doubling down on conviction. Over the past few days, we've seen two interesting voices resurface in the Opendoor conversation. Eric Jackson, who's now in his 54th straight day of publicly campaigning for the stock, posted a short video where he talked about taking chances in life if you want to make it big. That line might sound philosophical, but it applies perfectly to where Opendoor sits right now, a company in transition, with enormous upside potential if it executes, and a market that still doesn't quite know what to make of it. At the same time, Keith Rabois, Opendoor's co-founder and now chairman, made headlines with comments that confirm what many investors suspected: the company has been quietly rebalancing its workforce. Rabois said that while Opendoor currently employs around 1,400 people, he believes the company could run effectively with closer to 200. Now, that might sound harsh at first glance, but in reality it signals something important: that Opendoor's leadership understands efficiency, understands leverage, and is willing to do the hard internal work to scale sustainably. It's not panic. It's pruning for performance. And then there's Nejatian, the CEO, continuing to post on X with his trademark mix of candor and forward-thinking. Earlier this week he revealed that Opendoor's procurement team has gone, as he put it, AI-pilled, using internal tools to cancel redundant SaaS contracts and consolidate systems. He said the company was moving from 10 different vendors down to one, plus their own internal AI tool, saving millions of dollars a year. This isn't just trimming costs for the sake of it. It's building a culture where every process is data-driven, efficient, and scalable. So when we combine those threads, cost discipline, workforce optimization, leadership transparency, we start to see the real picture emerge. The fundamentals are improving even as the share price takes a breather. And it's not just insiders who notice. People like Anthony Pompliano have openly said they've been buying more of the stock during recent dips, calling it one of the most misunderstood plays in tech right now. That kind of conviction doesn't come from hype. It comes from studying the underlying business and recognizing where the optionality lies. And speaking of optionality, there's another development that flew slightly under the radar but could become one of the most exciting long-term catalysts for Opendoor. In a recent statement, Kaz confirmed that Opendoor will begin accepting Bitcoin and other crypto payments for home purchases in the future. That's right, a real estate giant opening the door, literally, to crypto transactions. It's a huge symbolic move that aligns perfectly with Kaz's earlier discussions with Robinhood CEO Vlad Tenev about tokenization and blockchain's role in reshaping real estate. It might not happen overnight, but it shows where the company's thinking is headed, toward a world where liquidity, transparency, and automation become the standard for property transactions. Now, let's zoom out and talk about context. The macro environment remains challenging. Interest rates are still high, affordability remains tight, and buyers are cautious. But there's a shift happening in sentiment. We're starting to hear hints from the Federal Reserve that inflation pressures are moderating. The next Fed rate decision could easily become a turning point. If the language tilts dovish, or even if the market perceives a pivot is on the horizon, housing-related stocks like Opendoor could see renewed momentum very quickly. Lower rates mean cheaper mortgages, more inventory movement, and greater transaction volumes, exactly the conditions that Opendoor thrives in. And that timing lines up perfectly with another important date, November 6th, when Opendoor reports its third quarter earnings. That's less than a month away now, and it's likely to be one of the most watched updates in the company's recent history. Why? Because the last few months have been full of transformation. We've seen major leadership upgrades with John Legreis joining from Shopify to lead operations, Morgan Brown from Dropbox to drive growth, and Brad Borney stepping up to run partnerships and sales. This upcoming earnings call is the first real opportunity for the market to see what this new leadership structure has achieved behind the scenes. If we get even modest improvements in transaction volume, gross margin, or cost efficiency, it could be enough to flip the narrative. Investors aren't expecting miracles. They're looking for evidence that the internal changes are translating to measurable outcomes. If that happens, the conversation shifts from survival to strategy. Meanwhile, market volume has dropped substantially. Trading activity in Opendoor is down more than 50% compared to earlier peaks. That might sound like apathy, but historically, Volume contractions like this often precede major directional moves. It's the calm before the breakout, energy consolidating before being released. Carvana went through a similar pattern. Palantir did too. In both cases, the sideways periods were the accumulation zones, when conviction investors quietly built their positions before momentum caught up. And that's exactly why this moment matters. We're not in a hype cycle. We're in the accumulation phase, the period where emotion fades and fundamentals start to set the floor. When you have a CEO using AI to streamline operations, a chairman calling for efficiency, institutional investors like Jane Street holding stakes, and influential voices like Pompliano and Jackson reinforcing the narrative, it tells you that the story is far from over. So what's next? Let's look ahead at potential catalysts that could drive sentiment in the coming weeks. The first and biggest is the Federal Reserve's next rate decision. Any hint that rates will stabilize or begin to trend downward could reprice housing-related equities almost instantly. Remember, Opendoor's core business depends on velocity, on people moving, buying, and selling homes. The company has already proven it can manage through tough cycles, but a rate tailwind would amplify everything it's doing right now. Next, we have Q3 earnings on November 6th. That's the near-term test. Expect investors to zero in on three key metrics: cost per transaction, gross margin, and cash flow direction. If Opendoor shows continued efficiency gains and even modest sequential growth, it validates the restructuring. The leadership team's narrative becomes data-driven reality. Third, housing data for September will likely drop in the next week or two. Early estimates suggest we might see stabilization in existing home sales and a slight improvement in builder sentiment. That's subtle, but for Opendoor, even incremental improvement in liquidity helps. It's a sign that the market may be finding equilibrium. And finally, the wild card, crypto integration. If Opendoor releases even a pilot update or demonstration of crypto-based home transactions, it could reignite mainstream attention. The crossover between property and blockchain is still young, but Opendoor has the brand, the tech infrastructure, and now the leadership vision to make it real. So, how should investors interpret all of this? The short answer is patience and perspective. Stocks like Opendoor don't reward the impatient. They test conviction. They build frustration before they build momentum. But when the tide turns, they can move dramatically, because the float is light and the narrative flips fast. What makes this phase so interesting is that the company isn't waiting for a bull market to fix things. It's fixing itself in the middle of uncertainty. That's the mark of a company positioning for endurance. When Rabois talks about needing fewer people, he's not talking about cutting muscle, he's talking about trimming excess so that the core can move faster. When Kaz talks about AI eliminating redundant contracts, he's not talking about saving pennies, he's talking about embedding intelligence into the company's operating DNA. When Pompliano says he's buying more, he's not chasing a bounce, he's betting that execution will eventually overcome perception. That's the story worth telling this weekend. It's not about today's price, it's about the architecture being built for tomorrow's performance. And in the end, the market always catches up to the fundamentals. It might take a few more weeks, it might take a few months, but history tells us that efficiency, innovation, and conviction eventually win. So as we head into the new week, here's the takeaway: the noise will continue, but the signal is strong. The company is leaner, the leadership sharper, the product roadmap broader. The narrative hasn't broken, it's just maturing. The next few weeks will bring clarity. We'll get macro cues from the Fed, data cues from housing reports, and company cues from earnings. Each of these is an opportunity for Opendoor to reassert its trajectory. Until then, this is where conviction matters most. If you believe in the long-term vision, in the fusion of real estate, AI, and now even crypto, this is the phase to stay focused. Because when quiet conviction meets visible results, that's when the breakout happens. And that's what Opendoor is quietly building toward, right here, right now, under the radar.